You're watching Stock Watch this week. I'm Zinati Kuma, and joining me to unpack your stock-related questions today via Zoom, Chantal Marx from FNB Wealth and Investments and Nader from Benguela Global Fund Managers. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag StockWatch. Thank you so much for your time, lady and gent. I want to start off with you, Chantal. Actually, just on the Vodacom Remgro massive deal. It's good news because the Competition Appeal Court has approved it, but I actually noticed the share prices didn't really react, and I'm wondering if investors just have fatigue at this point, or what is happening there?
Yes, it has been a whole soap opera over the last few years with this specific story. But I think the reason why the market hasn't reacted is that a couple of weeks ago, Vodacom and Remgro told us that the Competition Commission actually decided to not counter at the appeal, because the Competition Commission essentially recommended that the tribunal don't approve the deal. The tribunal then didn't approve the deal, but the competition authority said that they're not going to counter them at the appeal court. So the expectation was that the Competition Appeal Court would find in favor of the deal and that it would go through. So your market reaction would have happened then and not today.
Okay, I see. So already baked in. Grant, is this something that you would be adding onto the fundamentals of the businesses, both Vodacom and Remgro?
Look, I think it is a positive for them, but I don't think it's big enough in isolation to move the needle. You know, you build it in your model, and we know it's an opportunity, but these are big businesses, and so I don't think it's a game changer. It's just a nice, add on, sort of complement to what's there. Yeah.
All right. Well, let's talk about banking, because at Nedbank, even that one, we had already known about it. They flagged it in their interim results that they would be getting rid of their interest in EcoBank, and we saw that coming through today. Also, not a lot of reaction. They're talking about a strategy reset in the rest of Africa operations. Just considering the fact that people have not been happy with Nedbank, I'm wondering if this changes anything, Chantal?
Well, I think that it definitely removes an element of volatility within the earnings profile of Nedbank. So I think it's going to be easier for investors to value the company and to predict earnings, which is always quite helpful. What is more interesting to me, though, is the fact that they're effectively redeploying this capital into the South African market and specifically into the fintech space. They announced that acquisition a couple of days ago. And I think it's a step in the right direction for them. They've been losing market share in the small and mid-sized enterprises business space, and it's been an area of strength for Nedbank for decades. But Capitec has really disrupted them there, and I think that this step into addressing an informal market requirement and really getting closer to their SME clients is probably one in the right direction.
And just in banking, we did have Standard Bank results yesterday. Grant, is Standard Bank one of the leaders there? Are they just firing on all cylinders, possibly maybe even treading close to Capitec?
Look, Standard Bank is doing a great job, but you just have to go back 6 or 7 years and you see where they were in terms of the kind of ROEs they were delivering in the sort of mid-teens or what. Now they're talking about target range of 18 to 22. That's moving towards the first range, which has long been the standout of the big four. And then, of course, no, they're nowhere near Capitec, but they're operating very well. And what they're doing incredibly well is their African franchise. They really have got their things together there. It's contributing. It has a high cost of equity, but it really is contributing nicely to the growth and the returns. And Nedbank's basically bailing out of that as Standard Bank is pushing into it. So it shows you two very different positions. I really like the way they're executing, managing the cost. They've got a really good balance in the business. Different franchises performing at different times. And the landscape in South Africa is heating up. As Chantal said, Nedbank's got to get its act together, but so does Standard Bank in the retail space. Capitec is coming for all these guys in the SME space. Yeah. So it's an interesting landscape. I think these guys are well positioned to be one of the one of those that stay ahead. The ones that worry me is probably ABSA and Nedbank.
Okay, I hear you on that. Well, let's get on to some of the questions. Are these future 10 baggers, and this is Metair and Afrimat, and I guess we can analyze them individually. Metair, I think they released a trading statement, and I think actually investors were quite happy about it. And Chantal, this is one that has struggled a lot. Do you think that it could get to 10 bagger status?
Well, I mean, if they get everything right that they're looking to get right, I don't see why it can't happen. The share is exceptionally cheap. It's trading on a 2 times forward PE. There is a reason why it's cheap, though. So firstly, they have a lot of debt on their balance sheets. They've just exited their Turkish business, and that Turkish business they had to basically panic sell. And they ended up with a lot of debt from that transaction. Additionally, they're very exposed to the automotive manufacturing sector. And I think the perception out there has been that the entire automotive manufacturing sector in South Africa is essentially dead, particularly because of US tariffs and the rise of Chinese imports. What Metair said in their trading statement, though, is that they haven't seen an impact on the original equipment manufacturers that they supply into, which would be in the main Toyota South Africa. Toyota South Africa still has the largest market share in terms of new vehicle sales in South Africa, and a lot of those vehicles are manufactured in Durban. So I think from a Metair perspective, things sounded worse and looked worse than it was in actual fact. And then additionally, they purchased a distressed asset, AutoZone, more recently entering the aftermarket parts business. And I think that that's going to complement their existing business exceptionally well. The problem is just that you've got massive forecast risk and massive execution risk. And that is why the share is so cheap. But I like it. I think it's one worth backing. Don't bet the house on it. But I think it can potentially be a really nice sweetener in your portfolio.
All right. I think Chantal has given us a lot of detail on Metair. So Grant, I'll come to you with Afrimat. I mean, hasn't Afrimat been a 10 bagger historically? And of course, we're seeing pressure now. So could we see them repeat that formula?
Look, I don't know about a 10 bag, but historically it's been a great performer, a great management team. They've consistently created value, made smart acquisitions, moved smart places in their business. They've done good things. They made a big step into the cement space, a space they do know, by the way, but that I think the Lafarge acquisition has proved to be quite challenging and harder to digest. But I think they'll get it right because they have a history, in fact, their origins in that similar space. So it will take time, but I think that will come. The other thing is they're exposed in the iron ore space, and their fortunes are tied somewhat to the whole challenges around the ISCOR steel production. And so they've got, or ArcelorMittal, not ISCOR. And iron ore, as we know, has been a very difficult space to operate in for the last couple of years now. So if that turns around, or at least finds a bottom, and they get that, and they start seeing the cost synergies come through and turning around, some upliftment in the SA macro environment, perhaps through infrastructure delivery, I think this is a good level to be looking at Afrimat. I think you can buy it here. I think you might need to be patient. I don't know what the timelines are, but it's a good entry level for a good business with a good management team. So that would be my view.
You just showed your age there, Grant, with ISCO reference.
I am, hey?
All right.
And I wonder if people remember that out of ISCOR came Exara and Kumba back in the day, and ArcelorMittal. So,
well, thank you for educating us. All right, let's go into chicken. How will this sector be, the poultry sector, how will this sector be exposed given USA imports emanating from SA-USA trade deal? I mean, obviously the agricultural sector exposed to the tariffs, but chicken specifically, Chantal?
Yeah, I mean, just to start off with, ISCOR is still a very popular name for ArcelorMittal in the Vaal, where I emanate from. But apart from that, the chicken story, it's quite interesting. We don't actually export our chickens in South Africa. We actually don't even produce enough to feed ourselves. We import chickens, and we do import chickens from amongst other places, the US. US consumers only like the white meat. They don't eat the red red meat or the pink meat in chickens. So we're a really nice market for those IQF chickens that you get in the frozen packs. But we're not impacted by US tariffs because those tariffs are only levied on companies that are importing into or exporting into the US. So from that perspective, we're quite cushioned. What I would also add around the chicken sector, it's very volatile. It trades in cycles, and we're probably in a really good cycle for chickens and poultry right now because we've got grain prices under a little bit of pressure. That means your input costs are less. We're also coming off of a period over the last couple of years that has been heavily impacted by avian influenza. Load shedding has been a problem for these guys, and both of those issues seem to have faded into the background this year. So I'm positive about the sector near term. Longer term, I'm not interested in being a long-term holder. They just put it there.
Yeah, that's the thing, because the general narrative that I get from you guys is that just treat it like a commodity stock. Grant, and it's actually quite interesting because Roy Mutooni yesterday chose Astral Foods as his stock pick from the numbers that we recently got out of Rainbow Chicken. Would this be something that would interest you at this point, Grant, or you just stay away from chicken?
Look, it's not something I'm especially interested in because I find these some commodities are easier to understand than others, and this one, there's so many moving parts. But Chantal's right about all the headwinds that they've put behind them. Load shedding was one of them. They've still got challenges around water supply. Grain prices are unpredictable, so they don't have a lot of control over things. So you absolutely need to be deliberate. Don't buy and hold. Buy and trade. It's probably it's optically cheap. Probably not a bad time. I don't have the conviction to be playing in this space.
All right. Well, a very interesting question just came through. Should I sell my Boxer shares for Aspen? That's actually a very, very interesting one because we know that Boxer continues to be the star performer in that Pick n Pay stable. And then Aspen, of course, now there's a lot of uncertainty, with how their business is to grow from here on out. I mean, would this be something that one should even consider, Chantal?
So you're basically looking at two different trades, right? And on the Boxer side, you're looking at a high growth company that has very strong management, very strong cash flows, executing well, growing very quickly, but it's fairly valued, okay? Maybe even a little bit stretched in terms of its valuation. But I think you can sleep soundly having Boxer in your portfolio. Your second trade is buying Aspen. Now, Aspen is very cheap at the moment, but it's cheap for a reason.
Yeah.
They lost a huge manufacturing contract, and they're going to struggle to fill it. We know that Steven Saar, the CEO, has been buying shares in the company, so at least he feels comfortable with the longer-term investment case. But I would want them to start seeing I would want to see evidence of that capacity being filled before I will get involved with the share. I think it's very risky at this point in time. I'd rather, short answer, hold on to my Boxer for now. And I mean, it's a very difficult thing because you're looking at two fundamentally different operations and points in terms of where they are in their business journey right now.
And does this also grant not, is the viewer just not thinking that, I don't know, Boxer may have reached its peak and that maybe we could see more growth in Aspen? I don't know, how does one even approach that?
I think you need to ask yourself, what are you holding them for? So if you're holding a Boxer, it should be a core component of a nice portfolio with quality companies, then you hold it because it's still going to deliver the growth over the longer term, and the valuation could fluctuate up and down over the next while. Maybe it's a bit stretched, then it's a bit cheaper, but the compounding of returns is coming. So hold on for the ride, don't fiddle with it. Aspen is almost like giving you a bit of optionality. If you think Steven Saar's going to get it right and strike a deal and put a new contract, even if it's half the size of the one they lost, there's going to be some sharp realization of value there. But you're speculating there. It's not obvious and not clear that that's about to happen and how they're going to go about it. So, from where I sit, we'd rather sit on the sidelines on that one at the moment. But if you want to play in that space, treat it as a speculative position for now until there's further evidence of something otherwise, which means manage your position size, manage your exposure, and don't replace a high quality core portfolio position with this position. So that's what I would say.
Okay, I hear you. Well, there's a question here. Could you ask your panel which South African shares to buy for the long haul, especially with a buy it and hold for life mentality? We already know that Astral is not one of them. Chantal, which what would you have in mind? In terms of being able to sleep at night. I mean, you just spoke about Boxer now. Would there be any others?
Yeah, I mean, so you can identify the highest quality companies with the most stable management teams and where you can see decent growth runway still. I think in the retail space, you would want to go for best in class. So companies like ShopRite, Mr. Price, Pepkor. In the banks, Standard Bank, FirstRand, Capitec, all of these companies you can be very comfortable with. In insurance, I think there's still very strong growth runway for the insurers in South Africa. Sanlam probably the highest quality pick, but you can rest easy with momentum in your portfolio as well. Santam, Outsurance, both very strong short-term insurance holdings. And the list actually goes on.
Yeah.
If you want something that kind of gives you exposure to lots of sectors, you can look at something like Bidvest. You can look at Remgro as well. So, I mean, there are options. And then if you want really cheap, cool, random stocks, you must scratch around in the small cap space. I think that there's plenty of opportunity there as well.
Okay, yeah, interesting. You mentioned a lot of financial services companies there. Grant, any kind of specific sectors or specific companies that you would say you buy for life and hold for life?
Look, I would definitely say that the names Chantal threw around are all good quality businesses. You can hold them. Outsurance is probably one I'd add to the list because they've got a nice growth trajectory in Australia and Ireland still with a long runway for growth. So I like that little bit of growth opportunity as well. Sanlam, I think the Indian operation is still undervalued. I think there's big opportunity there over the long term. Bidvest is another one. Clicks, I think, was unmentioned, but that's worth looking at. I mean, you probably, probably nailed it. I think Capitec will remain one of the best performers by a long shot. I think it's a very underappreciated how good that business really is.
I'm surprised you guys aren't mentioning Richemont and Naspers.
I was just about to say Naspers is, without a doubt, probably one of the best companies in the world is Tencent, in my opinion, especially given their positioning across multiple verticals of opportunity around AI and monetization. You've got a hybrid of Meta, Google, and a cloud hyperscaler all rolled into one, and a gamer, and like a NetEase. So that is a phenomenal business. I would definitely hold that. And Richemont, but you can definitely hold Richemont. It's cyclical. It's going to go up and down, but it's already in the last 6 months has showed how much better its jewelry portfolio is or its watch portfolio. It's a really high quality luxury goods company. So those are definitely sleep at night companies.
Okay, Richemont and Naspers on your side, Chantal?
Yes and yes. I just didn't think that they would fall under South African companies
because
they have a very small exposure to South Africa. So even though their heritage can be traced back to I mean, they're largely kind of European, China exposure companies, but they definitely, if you're buying them on the JSE, sleep at night companies.
Okay. There's a question. You have 100,000 Rand. Select 4 stocks. I don't know why 4. But okay, select 4 stocks for the 2 to 3 year period. 100,000 Rands. If it's 4, then clearly, surely, Grant, you are shopping in small caps?
It depends if that's all you've got.
Yeah.
Because, okay. I suppose it's a 3-year time horizon.
Yeah.
I think you probably have fun in the small caps, as Chantal mentioned earlier.
Yeah.
Your opportunity, if this was like an investment competition where the game was, who hits the most in the next 3 years, what's your return profile, then you can find that like 2-3 times earnings opportunity for sure.
Okay.
I would say that's probably a good place to fish if you want to play that game.
Grant, I know you've mentioned capital appreciation. Would that be one of the stocks you would?
Yeah.
Okay.
It's a great little business. A very great little business. I think Lusaka Technologies is one that's becoming interesting, especially given the move from Nedbank. It's putting the space in play. This fintech disruption is a real thing, and it's moving fast. and it might ignite a few more people to look around, and that would be one of those that one would look at, along with maybe capital appreciation for that matter. So some interesting ones there.
It's actually nice that you don't just get exposure to technology with the big ones like Naspers, that you can actually get opportunity for exposure in that in the small cap space. Chantal, 100,000 rand, where would you be going?
Yes, I mean, I think that I'd probably not. 100,000 rand. That's, let's say, 25,000 rand per stock.
Yeah.
Maybe if again, it depends on what the point of it is, right?
Yeah.
If you want to save towards your long-term goals, you would want probably, you can play around a little bit. If you're risk averse, you don't necessarily want to play in the small cap space. So perhaps I'll take 2 safe bets, and then I'll take 2 speculative bets. We spoke about Afrimat and Metair earlier. Those would be speculative bets.
Okay.
And then safe bets, kind of 1 retailer, 1 bank. So perhaps kind of think about that. I've got a retailer as my stock pick today. Capitec is also an option if you don't want to be in a big bank. Not Capitec, capital appreciation.
Yes.
Because you play into that financial services sector, and it's just a really lacquer company, and I think 25 grand exposure to that could be good enough.
All right. Well, let's get to your stock picks. Grant, where are you finding value today?
So I am picking Mercado Libre, which is, if you had to take Amazon and PayPal and maybe a Visa and have them all have a child, that would be Mercado Libre. So it's the preeminent e-commerce and fintech player in Latin America. Biggest player in Brazil, they're growing fast in Mexico, dominant in Argentina and 18 other countries in that area. It's a very strong business. They've invested a lot in the logistics, in building that moat. They've got a massive growth runway, both in e-commerce and in the fintech space, credit card lending. If you think about Nubank, that other Brazilian bank, they're competing head-on with them, and they're doing a great job in the space. It's just a great company. It's not that cheap, but it's a high-growth company. So if you can stomach a little bit of volatility with a long-term timeline, it's a great stock to own. So that's my pick, Mercado Libre.
Okay. Chantal, what are you buying today?
I'm doubling down on the SA retailers. So I've been picking them for the last 2 weeks, and they've been sold out off horribly because we've had some trading updates coming through showing that June was really poor. And this came through in the retail sales data as well. But June looked bad because of a very strong base. Last year, we had school holidays in June, so there was foot traffic in malls. Last year, we had the GNU optimism after 2 months of no one spending anything. And last year in June, that's when winter only arrived last year. And this year, that wasn't the case. We had a normal kind of seasonal story playing out in this winter. So a lot of the winter buying happened in May. Which is the normal thing. So June looked artificially poor, but most of the retailers, except for Truworths, they didn't say anything, said that July looked a lot better. So I think that it's an underappreciated opportunity at the moment, given the macroeconomic tailwinds that the consumer is facing currently. TFG looks very cheap. Mr. Price looks very cheap. I've already noted those as some of my stock picks over the last 2 weeks. So today I'm going for Pepco. There you also get a bit of a fintech sweetener.
Okay, lovely. Well, thank you so much for your time and your analysis today, lady and gent. That was really, really fun. Do enjoy your weekend. Thanks to my guests, Grant Nader from Benguela Global Fund Managers and Chantal Marx from FNB Wealth and Investments. Do remember that Stock Watch pre-records on a Monday and Wednesday at 1 p.m. and is live at 6:30 p.m. on a Tuesday and Thursday, while Stock Watch this week is live at 12:30 p.m. on Fridays. Keep that in mind and keep your questions coming. For now, that's all from Stock Watch this week, but do stay tuned for lots more coming up right here on Business Day TV.